Welcome to the Arrived Single Family Residential Fund, which is now live. Our speakers for today are Ryan Frazier, our CEO and co-founder of Arrived, Cameron Wu, VP of Investments at Arrived, and then my name is Corinne Headland, and I lead our investor relations team here at Arrived. A quick disclosure, so we are all aligned. This is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. Today's agenda, Ryan will be walking through who we build for, the single family residential that is now live, the fund, market strategy, property selection by Cameron Wu. Ryan will actually walk through a live demo, and then we'll jump into the Q&A. So feel free again to drop those questions in the Q&A. That's where we will be leading from after prepared remarks. All right, Ryan, I would love to invite you up to the stage.
Awesome. Well, first of all, Corinne, thank you so much for getting us kicked off and for bringing us all together to launch the Arrive Single Family Residential Fund. Before we talk about the fund, I want to talk a little bit about how we got here and why we decided to build this for investors. And first of all, at Arrive, we believe in building for our investor community, which includes everyone listening in today. And we work hard to listen to your feedback and how we can improve the experience of investing on Arrived. And one theme that we've heard regularly from investors has been about diversification. We also talk a lot about dollar cost averaging and spreading smaller investments across a number of properties over time. You can move to the next slide. And we're frequently asked if there's a way to more easily diversify or invest in sort of an index fund of Arrive properties. And for anyone who joined our summer product roadmap webinar with Alexa, our head of product, we shared this sort of way too early digital napkin sketch of how we might address some of this feedback and introduce the Arrived Funds product. And we committed to building this for investors. And if you move to the next slide. Okay, here's our digital napkin sketch that I mentioned. Okay, you can jump forward. And so today, that's what we're launching. The Arrive Single Family Residential Fund is now available to all investors on Arrive. You can access it through our website or through our mobile app on iOS. And so I want to talk a little bit about a few of the core pieces of investor interest that we plan to address with our first fund. With Arrive funds, investors are instantly diversified across several properties and markets. And new homes are going to be continually added to the fund, kind of growing that diversification over time as well. For people who want to invest more significant amounts at a targeted point in time, instead of waiting on individual properties to invest that in, the fund offers more flexibility for that and higher max investment thresholds than an individual property can allow for. And while real estate investments have historically performed best when they're held with a long-term view in mind, we've also heard from investors that they appreciate having an option for liquidity. And so with the fund, investors will have an option to redeem or liquidate their shares on a quarterly basis after the first 6 months of their investment. So with that in mind, let's talk a little bit about the single family residential fund and how that compares to our individual property offerings, because we're absolutely going to continue to make individual property offerings available as well. And so we'll compare the single family residential fund to single family residential properties, since that's what will be in this first fund, and not vacation rental properties as an example. So first of all, both products will benefit from the same favorable REIT taxation. They'll have the same initial investment minimum of $100 to get started, and they'll both earn investment returns in the same way, through dividends from rental income on properties and potential appreciation from property value growth over time. And then there's also several unique aspects to deciding if to invest in a fund or in individual properties. First of all, the kind of initial one is just that within a fund, you're investing in a pool or a portfolio of homes from the start versus picking and choosing individual homes to invest in. The fund will provide access to liquidity on a quarterly basis after the first 6 months. And our individual properties, while we're still developing a program for liquidity within this program, for now, investors should invest with the estimated 5 to 7 year target investment period in mind. With the fund, the diversification is really built in from the start because you're investing into a pool of properties. Whereas with individual properties, that diversification is in the hands of each individual investor to decide, what cities do you want to invest in, what properties do you want to invest in, and what time do you want to add new investments to your portfolio. So really you have that full control in that regard. With the fund, it's intended to be sort of always on and available to invest in on an ongoing basis. And our individual properties will continue to follow a weekly or bi-weekly drop schedule where we're introducing new properties as they become available. And then the last is that the fund will have some economies of scale in business operating expenses around the LLC, tax, and audit costs, since those will be pooled inside an individual offering, whereas within single family or individual properties, those are at the individual property level. And so with that, I'm going to hand it over to Cameron, our VP of Investments, to talk a little bit about the fund's portfolio strategy, and then we'll do a quick demo and open things up for Q&A. All right, Cameron.
All right. Thanks, Ryan. And thank you all for attending. Really excited to have you here and really excited to launch our first fund, the SFR fund. So, the key word on here is portfolio, right? Up until now, we've really focused on individual property offerings, right? Where you are constructing your own portfolio for a low minimum entry of $100 per investment. So I want to go over what some of the components of our portfolio is as we construct this SFR fund. So we'll go over a couple of themes here. So first is our core portfolio. And this is really descriptive of what you have been seeing with our individual property offerings. So there's a couple themes going with population growth, right? Ultimately, people have to live somewhere. So we're looking for the MSAs, which stands for Metropolitan Statistical Areas, really just a market. We're looking for the areas with sufficient population growth as well as a robust economy, because ultimately when it comes down to people's ability to afford housing and where the next hot markets are, it's dependent upon where people are going and where jobs are. So some of those factors that go into what our core portfolio is have to do with the price points as well as the infrastructure of the city. So, there's a lot of nice places to live in the US, but there's only so many that have sufficient infrastructure and sufficient population to really start taking off. We're looking for MSAs that are typically a couple 100,000 people, but around 500,000 people. So those are really primed for more appreciation potential, as well as being affordable enough today such that you can get a good cash flow. So as we've been offering these individual properties that are part of our core thesis and our core markets, we're looking for that balance of cash flow and appreciation. But then in a portfolio, while that's your core, you also have some flexibility to start taking some bets on either side, right? Whether they're cheaper properties or more expensive properties in appreciation focused markets. So I want to go through a couple of those. So long-term growth potential and cash flow, what does that kind of imply? So, I grew up in Texas, and I went to school in Austin, and there's this neighborhood in Austin that's referred to as like East Austin. It's part of the city where it was kind of economically, lower on the totem pole historically. So if you had asked anybody 10, 15 years ago, would you invest in East Austin? A lot of people would have probably told you no. You fast forward to today, and it's bustling. It's where all the new restaurants are going. It's where all the new nightlife is. It's where all the new developments are. So, there's a phrase that one of our teammates likes to use where he says, you don't go where the puck is right now. You try to anticipate where the puck is going to be, right? So that's where long-term growth potential and cash flow come in, where we're investing in areas where the core market is still part of our, conviction and fundamental thesis, but the price points of certain neighborhoods are currently lower where they're improving. So, North Little Rock is another good example. Some of you may be invested in those homes there, and you can buy brand new homes for $180,000, right? They're 3+ bedrooms, 12 to 1,500 square feet, and they're in improving areas. So while they still may exhibit some price point challenges today and the neighborhood is developing, we felt a lot of conviction because there were some really nice waterfront developments and large condos and commercial development going on there. So in the moment, it's a little bit tough to invest, but on a longer term basis, which, as real estate investors, we always look for the longer term, we felt a lot of conviction. So that's an example of some neighborhoods and markets that have long-term growth potential that can offer that higher cash flow. Now, on the other end of the spectrum, premium neighborhoods, within those core markets that we really have conviction with, there are neighborhoods that are just the best places to live. And even if they are higher priced, a lot of times they can experience really great price appreciation, especially when the mortgage markets have opened up and borrowing is more affordable. That will typically push the price points higher. So I lived in Las Vegas for almost 10 years before I moved to the Seattle area. And as we were leaving the town, my wife was reflecting on just the real estate market at the time. Because when we had moved there, Las Vegas was definitely kind of in the dumps with respect to, the price of the properties in the real estate markets. But by the time we left, almost 10 years later, the areas that had experienced the most price appreciation were the nicest areas in town. So if you're familiar with the Summerlin area, that place had taken off tremendously. So we were thinking, man, if we had just bought a home at the time in those nicer neighborhoods, then we would have, made a lot more on our property than we actually did when we had sold it. So premium neighborhoods, they can be challenging investing in individually because with a higher price, the cash dividends are not quite as high on those, right? And you would expect that because renting, you can only pay so much for rent, right? Whereas the price of a property can stretch pretty high. So with those dynamics, you have higher prices and lower rents, and you just don't have a really satisfying yield. However, the appreciation component can outperform the general market. So as part of our strategy, as we build this portfolio, we're really looking to diversify properties in different markets and at different price points, so we can get a really good, not only just a good return, but a good risk-adjusted return. And there's a subtle difference between the two, because if we were saying, hey, we just want the highest returns, we may be taking on too much risk. We may be doing all flips, and there's certainly a set of challenges with trying to be a property flipper. Or maybe the highest returns are all in buying the cheapest price points that you possibly can. But that's not without its own set of risks with respect to evictions, delinquencies, and just issues with the properties and poor construction. So, it's not part of the core strategy to go too heavy on low price properties or go too heavy on high price properties. You really kind of want to be in that middle across different markets. But with a portfolio that we're building, we can take selective bets on either end of that portfolio with cash focus or that appreciation focus. And the last area that we can take bets on as part of our portfolio strategy are appreciation focused markets. So those markets, they tend to be a little bit more expensive, a little bit coastal areas, or very high quality of life. So you can imagine that some places, say in Colorado, pretty desirable place to live, beautiful weather, beautiful scenery, but property is expensive there, right? So going to some of these appreciation focused markets, it's not going to be a huge part of the portfolio, but we do want to be making those selective bets, right? An example might be 25 years ago, California already seemed expensive. But if you bought California property 25 years ago, you're probably at the top of the food chain in terms of returns, right? So it can be risky to take on these appreciation focused market bets because the price points are already high. However, we've seen historically that a desirable place to live is desirable for a reason, and the market will continue to, reward people for investing in some of those markets. So while we don't want to stack too much of our portfolio into really expensive properties, it is a component of the portfolio strategy where we're going to be able to take those selective bets. An example is that in our upcoming fund launch, we're introducing a new market, Greeley, Colorado. Right. So higher price points when compared to the country, but more affordable when it comes to Colorado, and also still strategically located close to infrastructure and large population centers. So that gives you a sampling of how we intend to construct the portfolio and some of the different bets that we can take that are a little bit more palatable in the context of a well-diversified portfolio, as opposed to an individual offering. With that said, we do intend to make many of the markets and properties that are in the fund available also to individual property offerings. But, in a portfolio, we're able to make those bets with a little bit more certainty because you do get that benefit of diversification. So on the next slide, we're going to talk about some of the characteristics of those properties that we select. So as you've probably noticed that on most of our individual offerings, we're looking at newer properties, typically 2012 and newer vintage, but more recently, very heavy into new builds. One of the reasons for that is the price difference between a brand new construction property and a resale property. It's pretty low right now. Resale market is extremely tight right now, meaning that there's very little supply. And the reason for that is with interest rates as high as they are, people have been reluctant to sell their property because if they do, then they're going to have to, give up their 3.5% mortgage and then substitute into a 7.5% mortgage. So the resale market has been incredibly locked up for the last 15 to 18 months or so. So we've really shifted our strategy towards emphasizing newer builds. But like we talked about on the previous slide, we do have the potential to make some higher yields and built-in equity by going for properties that could use a more extensive rehab. Because ultimately, that's where you can get some discount is on properties that aren't easy to just bring online to the market. So with the strategy of looking for deeper rehabs, we find that in a fund context, it's a better proposition to be able to introduce a couple of these properties that do require that deep rehab for some immediate built-in equity. Now, as far as the asset itself, what are we typically buying? 3+ bedrooms, 2+ bath, and 1,200+ square feet. It's your very entry-level starter single-family home. But with that said, we have different expectations of, what that asset may look like in different markets. So there are different price points too that we would participate in, like I was describing on the prior slide. Most of our homes in our core markets and our core thesis are going to be between $250,000 to $350,000, right? I think our average price point has been about $310,000 in the last 12 months or so of all the properties that we've been bringing online. Now, with that said, we're also going to have offerings that are on both ends of the spectrum. So you could expect in lower cost of living areas or those cash flow focus investments, property prices that are below $200,000. And then in some of the markets, and as well as better neighborhoods within those markets that we're going to be looking for, you might see property prices from $500,000 to $600,000, right? Think about markets like Denver, Phoenix, Salt Lake City. Those are some of the markets where you would expect some of those price points. And generally, there's just a theme of portfolio diversification across our fund, right? So we've talked about markets, we've talked about price points, and we've talked about different thesis points. So that's really going to be the focus of how we construct our single family residential fund. And one of the main differences between the individual property offerings versus how we construct the fund. Now, with that said, we certainly invite you to construct the portfolio in how you want, which is why we want to make sure that all of the offerings in the SFR fund are materially represented as individual offerings as well. That's been a huge question that we've been receiving is, what could we expect to see in the fund versus individual offerings? And largely you will see the same, but they may just come out in different cadences and different proportions. But, we do want to allow people who like constructing their own portfolio to have the same opportunities that people have in the fund. So I'm sure there will be more questions in the Q&A, but with that, I'm going to turn it over to Ryan now for a live demo of our fund page.
Thanks, Cameron. All right, so a couple of things. One is that you'll see an updated invest page before we get to the single family residential fund here. And this is the new detail page for the fund. So if you scroll down a bit, we've added a kind of a new layout on the left side where we provide details around the fund, about the investment strategy. And then there's a separate tab related to properties that are going to be included in the fund. And investors will see this gradually grow based on new properties that are getting added over time. We will highlight the net assets within the fund. And for now, this is essentially the total dollars that investors have placed into the fund so far, right now as of today. And over time, it'll essentially be the net assets. So the number of properties or the property values owned minus any leverage or debt in the fund, and adding any other things like cash reserves. Over time, it'll also mirror essentially the price per share times the number of shares outstanding. But it's a way to give investors an idea of how much capital has been invested into the fund and what's the value of those investments. All right, let's go down a little bit just within this details page. So I mentioned we have kind of a new layout with the about the fund, investment strategy, and market selection. We have videos that investors can review with myself or with Cameron, kind of talking about these attributes of the fund. We also have a highlight of the historical performance related to individual single-family homes. So investors can kind of get an idea of how have individual single-family residential properties on Arrived performed in the past. And then scrolling down further, a little bit more detail on the liquidity or redemption program that we have available and the costs related to redemptions. And I'll kind of touch on that briefly. So with the redemption program, we mentioned that after the first 6 months of an investment, investors will have the option on a quarterly basis to redeem their shares. If redeemed within that first 6 to 12 months, then the cost would be 2% of the current price per share. After that point, if an investor has held the shares for more than a year, then it would be 1%. And then investors who hold for the long term, 5 years or longer, no cost for redemptions after that point. We also list out all of our asset management fees and offering fees and other expenses. The overall expenses for the fund do mirror that of our individual property offerings as well. The asset management fee is 0.25% of the net assets of the fund paid per quarter. And then investors can click to learn more about the offering fees or other expenses related to the fund. The one thing I'll also call out here that we mentioned earlier is that there are some economies of scale that the fund will benefit investors just around lower costs for managing the LLC tax and audit component of the fund. If you scroll down a little bit further, we have a link to our offering circular, which really has all the details related to the fund, and encourage all investors to review. And then common questions, which we'll continue to add as we get more questions from investors over time. If we click on the properties tab, so this has kind of followed us as we've scrolled through the page, you can see a list of properties that have been recently acquired and are added in the fund and kind of how they're diversified or laid out across the country. And if you click on a property, you can see details of that individual home. For us, providing transparency into each individual property, into the photography and aesthetics of those homes, into the rental details, purchase price, and recent activity is going to be an important part of the fund. We really want to carry the transparency that we have on our individual properties into the fund as well. And then you'll note that we've got market spotlight videos for each market that's being added to the fund. These are also in individual property as well, and really highlight the reasons why we are picking and choosing these particular markets. So with that, that's a quick overview of the fund. It should be available to all investors at this point within your Arrived account. And with that, we can move things back and jump into some of the Q&A.
Lots of questions today. We'll be using the question feature. If there are any one-on-one Arrived questions, we host our standard webinars that take place on Tuesdays and Fridays. It's a great place for it. We'll be focusing on the question feature today. So the first one in here, will one day this fund become public and traded over the OTC? Ryan, I'll kick that one to you.
Yeah, it's a great question. And for now, really the fund is meant to be invested in through the Arrive platform. So through our website at arrive.com or through our mobile app. It's possible in the future that there may be other ways to invest into the fund as well, but that's the plan for the time being.
Fantastic. Awesome. We'll keep moving along here. The only question I have, and not sure if it'll be covered, is whether we'll be able to exchange our current SFR investments or single family residential individual properties for units in the SFR fund. And for new folks, when we're referencing SFR, that's for single family residential. Ryan, I'll kick that to you as well.
Great. Yeah, so there's no, I appreciate the question. There's not the opportunity today to trade investments from one investment to another investment, but appreciate the feedback, and we'd love to learn more about your interest there and what you would have in mind. But no, there's not a way to trade investments between offerings.
Fantastic. All right. Moving back over. This one is from Jimmy Lee. Interested in how you are positioning the real estate investment trust or REIT versus your existing investment portfolio. So single family residential or vacation rental individual properties. Is it just about liquidity and diversification? Minimum investment in your existing strategy is pretty low. It's a minimum of $100 for both. So diversification is pretty easy to achieve. Also interested in fees. So this is a thick one, Ryan, with a couple different elements.
Yeah, and it looks like this one came in at the beginning of the webinar before we went through kind of the things in common, the fund has in common with individual properties and the things that are unique. And so we did talk through that a little bit in the webinar. I think the one thing that we'd call out is that individual properties are really for investors who want to have more control of what markets or what properties are part of their portfolio, and also what time they're adding properties to their portfolio. Whereas the fund, provides the investors who want to be, more passive and essentially invest in an individual offering that builds that diversification for them over time. There are some, benefits to investing in the fund if you do want that kind of passive diversification, like the ones that we had mentioned earlier. But that's really kind of the choice. I make the kind of analogy of it's similar to investing in an individual company on the stock market versus, an index or mutual fund.
Fantastic. Yeah, it's a great question. All right. Let's see. Oh, this is a fantastic one. This was submitted anonymously. What about the amount of leverage will be used for properties in the fund? This could probably be a little bit of a combo too, Ryan, between you and Cameron.
Yeah, I think we do intend to use long-term financing within the single-family residential fund over time. Right now, we don't have any long-term financing added. And Cameron, you can speak to a little bit of the decision of why we haven't added long-term financing yet and when we might.
Yeah, definitely. So with long-term mortgage rates where they're at, which is above 7% right now, and really closer to 7.5%, and not too long ago, 8%, we found that adding leverage was not a economic proposition that we thought was worth taking at this point. Now, we're firm believers in the power of leverage to add returns to the portfolio. So as interest rates creep back down, hopefully continue to creeping down as they have been over the last month or so, then we would expect to incrementally add a little bit of leverage over time. Now, the great thing about a portfolio is that if you add a little bit of debt, you can choose a much smaller range to amplify and juice it a little bit. And the way that it gets amplified is, I can kind of express it in a very quick example. Let's say you have a property that's $100,000 and 5 years later, you sell it for $140,000. And this is all cash, right? So that 5-year period, you have a 40% return because you got 40K more and you invested 100 in the beginning. Now, in that same example, if you had a 60% mortgage on it. So let's say that you borrowed $60,000 from the bank, you put 40,000 of your own money in. So in the beginning, you're not putting 100, you're only putting 40 for that same property. And then 5 years later, also sell it for 140. Then you made $40,000 off of your initial invested 40,000, which is 100% return versus a 40% return. So, it's a very simple example. And there's, a few caveats about why that number might be a little bit different, but more or less it highlights why leverage that's responsibly used can be a real accretive return enhancer. So, I would expect that as interest rates continue to come down, there will be selective properties that make sense to put mortgages on. So maybe it'll look like 15% leverage, and then 25%, then 30. And we believe in a pretty conservative leverage policy. You'll see that even when interest rates were really good, we typically levered our properties anywhere from 50 to 65% or so. And in the world of real estate, that's a very conservative leverage policy. So we like the tool and the option to use leverage, but we use it responsibly. And we don't ever want to over lever ourselves, because that's how people can get into real trouble, if the market takes a sudden shift like it did 15 years ago. So that's our view of leverage and how we view it as a very accretive tool to be used in our toolkit. And you can expect that we'll incrementally use it on the portfolio as the rates come down.
Fantastic. Awesome. Appreciate you both walking through it. There was another one in here from Matthew Fisher. Will properties in the fund be the same as those that you offer for single family properties? Will the fund be a minority investor in the single family offering? So Cameron, you walked through a little bit of the differentiator between the two. So I think there's two questions here, what the differentiator will be. And then Ryan, perhaps we could talk about the strategy for releasing individual properties in the future. I know there's quite a few questions on that.
Yeah, I think the first thing to note is that a property that goes into the fund is going to be wholly owned by the fund, and a property that goes as an individual offering will be wholly an individual offering for individuals to invest into. So currently there's not a plan to have split equity of any one property, whether between funds versus individual offerings. The first part of the question was, are they going to be materially similar properties? And the short answer to that is yes, right? As an individual, you can pick whatever concentrations you want and compose your portfolio as you see fit. But within the fund, we will largely offer the same properties as we do on individual offerings, so that all Arrived investors, whether they're fund investors, individual offering investors, or a combination, will have the opportunity to build a very similar portfolio.
Fantastic. And then Ryan, on the second portion, yep.
Yeah, I think Cameron really answered a little bit of the second portion as well. But we absolutely are committed to continuing to offer individual properties, as we have been, for investors who do prefer that control. And our approach is really what Cameron mentioned as well, that for the markets and types of properties that are getting introduced to the fund, we anticipate having very similar like properties available for individual offerings as well.
Absolutely. Wonderful. I'm seeing a ton of questions coming through chat. So as a reminder for new folks here, we are utilizing the Q&A portion to submit your questions. We'll be focused today mostly on single family residential fund questions. So if you're more looking for 101 Arrived questions, those are better suited for our Tuesday, Friday webinars. But keep the questions coming. Our team loves to see it, but just wanted to call out that we are answering through the Q&A. I am removing some if they're redundant and trying to push them together. So if you don't see your name pop up, know that I'm mixing it in here to pull out some themes. Ryan, you mentioned this one. It's from Desiree. Can we invest in the fund at any time, or is there a limited period?
Yeah, the intent is that it should be available to invest in at any time.
Fantastic. Another one in here from Jimmy. Is there a targeted expected ROI on the fund versus the single family property option? Ryan, Cam, you got it.
Yeah. So for returns on SFR, for a well-diversified portfolio, when we look at our income yields and when we look at historical appreciation from third-party data providers, we expect a range of about 6 to 10% for that well-diversified portfolio. And I think with our IPO properties, we've largely been targeting that same range. And the difference is how you get to that 6 to 10%. So a lot of the properties that we've been offering as individual property offerings, the intent is to have a well-balanced mix of that income yield and that appreciation. And just as a generalized rule, we've seen dividend ranges from the 4 to 5%, and then appreciation ranges anywhere from like 3.5 to 5, based on markets over the last 20 years. So getting there individually through your individual property offerings, there's certain properties that are more conducive to offering that balance. In a portfolio, you do have a large concentration of those core balanced properties, but then you can also get there by making some higher cash flow bets and then some higher appreciation bets, which was really the kind of the essence of the slide on portfolio strategy of how do you get to that 6 to 10% range. So we want to make some appreciation bets, we want to make some high cash flow bets, and we want largely a good balance. On individual property offerings, we've tended to be more in that core balance range, but over time, you'll see offerings, as people have more diversified portfolios, that the individual offerings will have more appreciation focused ones with lower dividends, and then vice versa.
Fantastic. And Ryan, you chatted through this one a little bit live earlier about liquidity. I think it's one of the biggest differentiators, obviously, from single family residential individual properties. So Martin had asked, is the liquidation available immediately on single family and vacation homes held more than 6 months? So maybe we clarify for new folks on the line where that differentiation is.
Yeah, so if you're investing in the single family residential fund, then that option for liquidity will occur after the first 6 months of your investment, and it'll be available on a quarterly basis. And the fund really gives us that opportunity to, provide a program like this because it's continuing to add new investments and grow over time. It allows for a redemption program where we're doing this share buyback option. And so that's really what's intended with the fund dynamic. For individuals investing in individual properties, currently the investors need to invest with the intent to hold for the investment period, the 5 to 7 year investment period. And we're still working on developing options for liquidity for individual properties as well.
Fantastic. And Ryan, I don't know that we talked directly about share prices, so it's a good one to clarify. How is the share price for the SFR fund determined, if it differentiates from from our other properties?
Yeah, the share price will also be updated on a quarterly basis going forward after the first 6 months of the fund. And the way that will be determined is basically the same as what we have for individual single-family homes as well. It'll look at the net assets of the fund and how many shares there are within the fund, and that'll set the net asset value. The current net asset value or share price is $10 as a starting point, the same as what we have started with on individual properties as well.
Fantastic. And just to go back on liquidity, to double down here, for the liquidity that we'll offer for the SFR fund, how is the price determined? Is it just the same of the assessed valuation at the end of each quarter for all assets in the fund portfolio?
That's right. Yeah, it'll be at the current share price at the time that an individual requests to liquidate or redeem those shares.
Fantastic. And I can take this one quickly. I believe is when invested in the fund and individual properties, would investors receive 2 1099 DIVs or just one? Correct. You would receive 2. So essentially 1 for the fund. And then if you've invested in vacation rentals and a individual SFR property, you'd get 2 1099 DIVs. We submit those annually and they'll be live within your portfolio view. I will mention here, and Ryan, I forgot to mention this when we were driving in the demo earlier, we have made updates to the portfolio view and also the transactions tab. You have our director of product, Alexa, in the chat today, as well as a whole host of folks. So let us know what you think. We'd absolutely love to hear from you. All right. Let's move through. There's quite a few questions I'm seeing. There's 83, so I'm going to sift through some of these. Ryan, you briefly talked through leverage, but I'd like to go back to this one. What amount of leverage will we use for properties in the fund? How would folks know if leverage would come in the future?
Yeah, so I guess to start, the intent with the fund is that it will have leverage over time. It's best to think about it in the same manner as the strategic refinance candidate that we have on individual properties as well. Over time, that means we might seek anywhere from up to 50 to 70% use of long-term financing within the fund. And as Cameron mentioned, timing of when we'll introduce that is really based on, when we think the market rate for long-term financing, the interest rates are favorable enough that when compared to the cash flow coming from the rental properties that we have in the fund, it provides what we believe, positive impact to the investment returns. And so that's really the decision factor. When we do decide to add financing, it'll be included in the top level metrics of the fund. So if you click on anyone who's browsing the fund on Arrived right now, there's a leverage percentage on the properties tab. to show what the total leverage is within the fund. And we're likely, for investors who are invested in the fund at the time of adding financing, we would let investors know.
Another one in here. Do you mean to say that the fund composition is not fixed as of the time of the offering? You will add additional properties later on and drop off a few. Does it mean that this is actively managed, not in terms of managing maintenance and rental, but also in terms of allocation and risk management? Great question.
Yeah, definitely. So for the fund, that works differently than the individual property offerings, right? So with the individual property offerings, we had been acquiring the properties, taking them through the qualification process, and then dropping them on the Arrive site, at which point you would invest. With the fund, it's a little bit different. So you're right that with a fund, we're going to be actively managing it by adding properties and matching the capital that's coming in. So investors would say, hey, I want a piece of the fund, right? And it would start accumulating cash. And then once we have enough to buy a property or a few, then we would then strategically add which ones would we think are best for, the accretive performance of that portfolio. So we expect that, if it's successful, which we hope it is, that we'll be adding a lot of properties very soon to it across different markets. And it'll really be a catalyst for us to build up our operations and our market spread and really get that instant diversification that Ryan keeps talking about with the fund.
Fantastic. One in here from Eric. And Ryan, earlier you walked through like the biggest differentiators, but one in particular, can you walk through how the fees and the load in the fund compare to individual property investments in the Arrive platform if somebody's new or curious where to invest?
Yeah. So the fees and expenses for the fund and for individual properties are on each of the detail page. We try to be, really transparent in sharing what those are. Within the fund, if you compare the single family residential fund to individual single family residential properties, the costs and expenses should largely be equivalent. The one caveat that I'd add is that the fund has likely some economies of scale and cost savings related to the LLC tax and audit filings, where on individual properties, we have an LLC and manage that LLC entity and the tax and audit component at the individual property level. And that will not be the case to the same extent in the fund. There will not be an LLC for each individual property. While there may be some different LLCs within the fund, be much less than on individual properties. So that can provide some just business operating cost savings for investors in the fund, and that would be passed on to investors. So that's one of the items to consider there.
Fantastic. And Cameron, I'll kick this next one to you from Daniel. Are there any tax advantages that flow to fund holders, perhaps versus our individual properties?
Yeah, they're largely going to be the same. Both the fund as well as individual property offerings are structured as real estate investment trusts. And some of the benefits there are one single layer of taxation, as well as a nexus of taxation to the investor, as opposed to where the property is located. So the two primary tax benefits that we typically associate with real estate, which is depreciation, which gives you tax deferred dividends, as well as long-term capital gains treatment on the gains from the sale of shares and properties. Those, I think the best way to think about the tax advantages is that you'd calculate it all at the fund level, and then that would just flow through in the income as well as the future appreciation, those tax benefits associated with that. They don't necessarily flow through as if, you can take a specific depreciation expense and kind of net that against the rest of your life and your business dealings. But largely with the individual property offerings and the fund, because they're both REITs, they have the same mechanics and advantages.
Fantastic. I see we have Stephen here today, which is wonderful. Ryan, just to clarify, is it effectively a buying pool that I will continue to buy more properties and get more investors in the future? Will there be a fund size limit, or will we know what we are buying into and what happens to cash until invested? Great question, Steve.
Yeah. So a couple of answers there. One is that yes, investors are investing into a pooled investment fund, they will be investing into a growing pool as well, where properties will be added over time. So really what you're investing in is, what are the properties that we've purchased to date, and then what are the properties that we will purchase in the future. We do have details of every property that's being added to the fund. You can view that on the properties tab, and you can click into each property to learn more about the specifics around the purchase price, the rental rate, the rental status, as well as market videos around why that market has been selected for the fund. So that's the intent with the fund. And then as new investment comes into the fund, that's what will be used to purchase additional properties. We may use short-term financing at times to accumulate additional properties into the fund. And that way we have properties available as new cash is being invested into the fund. And in the meantime, cash will be held in a interest-bearing account, for the benefit of investors. But really, our target is primarily to use that cash to go out and purchase rental properties, and also use very short-term financing to help with some of that timeliness. And that allows us to, let's say if we know approximately how much investment is coming into the fund on an ongoing basis, our investments team can plan accordingly for how they're adding properties to the fund, just to make sure that the investments that are coming in are fully utilized for real estate investments. I mean, that's really the intent.
Fantastic. Dividends. We haven't talked about this live yet, I don't think. So Ryan, I'll kick this one to you from John S. As an investor, how do we get paid? Do you have a planned distribution? Is there preferred return? We walked through that one earlier. What is the waterfall structure? So maybe we talk through when folks will expect to receive a dividend and how we'll communicate that.
Yeah. So first of all, there's one share class within the fund, and investors in the fund will be the full owners of the essentially economics of the fund performance, any of the rental income after expenses, and then any of the growth in the property values of the portfolio, which we represented in future share price growth. So right now you'll see the first 8 properties in 8 different markets added to the fund. As we get through this initial lease-up period for the first properties in the fund, then we'll start paying out dividends. We expect within the next 1 to 3 months from essentially today. And then after that point, we'll start paying dividends on a recurring basis. Our intent is that dividends within the fund will be paid on a monthly basis. I think if you were on the product roadmap webinar this summer as well, you probably heard that we're working on monthly dividends for individual properties as well. And so the intent is that we'll launch those together. But that's how dividends will be paid out. And then as a REIT, we're required to pay out at least 90% of the net income or REIT qualified income to investors. And our intent is to really pay out the full cash flow and then let the share prices represent the underlying property value changes of the fund.
Wonderful. Awesome, Ryan. Thanks so much for walking through. I know we're getting close to the top of the hour here. So Cameron is cruising through and trying to answer some of those questions via chat or the Q&A section for you all. So keep an eye out there. Ryan, jumping back to liquidity, I thought Paul brought up a great edge case here. What are the criteria for approval or not approving? Is this a hedge in a case a large investor or of investors choose to liquidate at the same time on that quarterly basis?
Yeah, that's a great question. And you should be able, there is a link to an FAQ and to the redemption program in our offering circular that has the full details of what some of those restrictions might be. But in simple terms, the SEC has restrictions on redemption programs and how much of the total net assets or investment dollars could be redeemed within a given quarter or given year. And so that limits our ability to redeem 20% of the current net assets within a calendar year, within a 12-month period. And so that's really the primary limitation that investors should be aware of on terms of like why redemptions may be accepted or not. The other thing that I'll add is the process for requesting redemptions and just a bit about how that would work, and how can we make that fair for investors. What will happen is once per quarter, we'll open up a window where investors can say, indicate interest that they want to liquidate their shares. We'll collect all of that interest, and then we will basically redeem them all at the same time. If for whatever reason we ever did hit that SEC cap on the redemption amounts, then we would redeem investors proportionally to how much we could. So let's say that we were able to meet 80% of the redemption requests and still stay under that cap, then we would do that proportionally to each investor versus picking and choosing investors who would be able to redeem. So that's a little bit about how that program works, and the one limitation on the SEC limits on annual redemption caps.
Wonderful. Awesome, Ryan. All right, moving back over here. Obviously, we know there's a ton of great players in the space, whether they're like Arrived or a traditional REIT or stock, bond, etc. How is the fund different from E-REITs or other common competitors in the space? Ryan, I'll kick to you.
Sure. Yeah, I think one of the big focuses is really the Arrived fund is focused on the single family residential asset class that we've been really bullish on for a lot of the reasons that we talk about here and on previous webinars. That the single family residential home market has just been so undersupplied for more than the last decade, and the supply of properties in the market is lower now because of some of the interest rate lock-in effect as mortgage interest rates have gone up. At the same time, interest from individuals in renting properties is also going up. People are looking to rent homes for longer. One of those reasons is the affordability that right now with where interest rates are at, the cost of owning versus renting a property, there's quite a delta there where it's more affordable to rent. At the same time, individuals are looking for more space as they're potentially working from home. And so we've seen that more people are moving out of apartments or out of city centers and into more residential homes. And so those two things, the limited amount of home supply, the challenges in terms of timeliness and cost to build new supply, and limitations on land development. And then at the same time, on the other end, increasing demand from people renting homes versus other types of housing is really making the single family residential space an attractive market. So that's really a big part of how we think about what the benefits of the residential offerings are.
Yeah, and I'd also add real quick that in the Arrived SFR fund, you'll still have the same level of understanding and transparency of all the individual offerings and what's going on within them. I think that's one thing that's really set Arrived, just generally apart from many real estate companies who often have funds, is that they're blind pool, meaning you don't know what the composition is. So, we think that's a hallmark feature of the Arrived experience in offering that transparency and just that granular detail of what's going on with each investment. And, expect that going forward, that'll continue to improve, whether it's in a fund or individual offerings. It's just part of the DNA of how we operate.
Fantastic. And Ryan, I'll kick this one over to you. Maybe we chat through our minimum and maximum investment in the fund.
Yeah, so the minimum investment within the fund is still $100. And the maximum investment or technical maximum investment is 9.8% of the total value of the fund. And really that maximum investment threshold is a REIT restriction. So to classify or register as a REIT and benefit from those tax efficiencies, that's a limitation there. But that's what that's the minimum and maximum there.
Fantastic. And it looks like some folks might be hitting a technical blocker. Alexa, our director of product, is aware in chat. The best resource will be support@arrive.com or the chat function in the bottom right-hand corner of our platform. Essentially, we can gather way more data there about your browser, where you're operating from versus in Zoom. Unfortunately, we can't see all of that information. So we want to support you in the best way possible. Feel free to send us a note there so we can balance impact. I know a few questions as well about if you'll receive a recording. Absolutely. Jake, our head of ops, just shared that in the chat. I know we have a ton of engagement here today, so we're doing the best we can to manage all of the details that are coming in here. Ryan, roadmap question. Since you talked a little bit about dividends, do we have a timeline for monthly and auto investing and kind of what that looks like?
Yeah, so this is something that we talked about in the summer roadmap meeting, and we've really been working for the product and engineering team has really been working hard on making monthly dividends a possibility. And one of the things that we've been developing to allow us to support that is a wallet balance on Arrive that we can then pay dividends to on a monthly basis without the issues involved in ACH payments that tend to slow down and can cause potentially errors in just the experience of receiving dividends. Right now, we are planning to make that available at the early next year, in the first quarter of next year. And over the next couple of weeks or so, we'll likely have more information for investors on that. So probably in January, we'll share more, but yeah, coming very quickly and excited to get dividends into the hands of investors faster on a monthly basis instead of quarterly. Yeah.
Fantastic. One in here from Steve. As we don't control the diversification, do you have policies as to how much is in one city or market?
Yeah. So as far as a hard target percentage, those aren't allocated by market. We think about it more like portfolio strategy. So within our core thesis, what percentage of the assets would be dedicated to that? And we estimate about 60 to 70% within that core thesis range. And then depending on the market, interest rates, and which areas are, returning well, then we'll go outside of that core thesis for the remaining 30-ish percentage, where it'll be high cash flow or more expensive homes in appreciation focused markets. So, generally that's how they'll be allocated across the portfolio. But as we've been mentioning, those opportunities will also be available as those individual offerings for investors.
Fantastic. Awesome. One in here from Craig. Can you speak to the regulatory limitations of the fund? The OC states, obviously we have 75 million in there. How many individual homes do you expect to be included in the fund when it's maxed out? Will the fund close when it hits the limit? Ryan, I'll kick that one to you.
Sure. Yeah, so that's a good question on the overall offering size. So the limitation within the registration framework that we file under, Regulation A, and that allows for non-accredited and accredited investors to both invest, and it also is how we operate the funds and disclose everything related to the fund, whether it's the details of the fund or audited financial statements. In terms of the overall size of the fund, the limitation under Regulation A is raising $75 million on a rolling 12-month basis. So that, in simple terms, could mean that the fund could add $75 million per year in new investments into the fund. And we intend to, continue to grow the fund alongside that dynamic over time.
Fantastic. I know we have a lot more questions to go. Ryan and Cameron, how are you both on time? I realize we're over right now.
Yeah, that's definitely, keep going for folks that want to stay on. And I do see a lot of open questions here. So thanks, folks, for bearing with us on getting back to you.
Absolutely. We'll give it a few more minutes here just to see how many we can cruise through. We might also have an additional one in the future, so we'll be sure to keep folks well prepared for that. Another one in here, will there ever be a vacation rental in the fund or a vacation rental fund in the future? Ryan, what are your thoughts?
There will not be any vacation rental properties in the SFR fund, but it is possible that we could introduce a vacation rental specific fund in the future.
And then I did see a question regarding sales proceeds and how they're treated from a tax standpoint. And maybe, Ryan, we chat through what it would look like and if the hold periods mirror what we see for SFRs right now, and what that would look like for folks.
Yeah, I guess I'll answer part of it, and then Cameron, if you want to talk about maybe the hold period for investments that we make. But essentially, for investors, the time when okay, we'll introduce or share tax returns on an annual basis on a 1099 DIV, and the kind of exposure that you might have is really around when you sell shares. Otherwise, you'll receive the rental income net of depreciation that can offset that rental income within the fund, and typically offsets a large portion of the rental income. That's one of the great benefits of the REIT taxation structure within the kind of corporate entity structure. Cameron, do you want to share anything on the individual, like how we kind of think about the investment period for each property?
Yeah, definitely. So, with individual property offerings versus funds, it's going to work a little bit differently, but I can still give some guiding advice on hold periods. So on individual offerings, we expect 5 to 7 years for SFR properties. And the reason being is that there's transaction costs involved with transacting real estate. So typically you don't want to trade away your gains, right? And then also we've seen real estate markets, they tend to appreciate, but there can be up cycles and down cycles like any asset. So with that longer time period, we expect that there'll be higher appreciation, if in the short term, you're not experiencing the appreciation for various reasons. Now, those are with individual property offerings, right? In a fund, it can work a little bit differently where there's a little bit more flexibility on the purchasing and selling of properties within the fund. So as Ryan mentioned, your capital gains tax impacts really happen when you liquidate the shares. But within the fund, we can have transactions where, if it's a net accretive transaction, and the way that I describe that is if we can take a property that's delivering, X% return, and after selling costs and after transacting costs of the new one, if it's still a better decision, then we can make those much more incremental decisions. Whereas with an individual offering, it can be more challenging because, some people may only have that one property or may not be diversified across a large set of properties. So the consequence of selling a property for a smaller gain, it's not an experience that we're looking for on the investment side. So the fund is materially different in that sense. So we do have that flexibility to continuously optimize the portfolio with the guiding light that net of transaction costs and fees, that it would still be an accretive transaction.
Fantastic. Awesome. And I realize wholeheartedly that I'm probably missing questions here. So definitely keep me honest. We also have support at arrive.com or our chat function that we're always happy to check in on after. The one in here from Duke, let me just make sure I understand this. How the value is being set on the home, such as rent, multiple, or DCF, or are you having a licensed appraiser setting the value each quarter? Cameron, I'll kick that one over to you.
Yeah. So the process for valuing the real estate and thus kind of the sum of all of that being, the share value will work very, very similarly to how we are valuing individual properties today. So on that quarterly basis, we use reputable third-party data to triangulate values. Now, it's not always going to be, exactly what House Canary says or exactly what CoreLogic or Zillow say. There's a kind of a process by which we use those comps, and then we also match it against what the expected what the go forward real estate market looks like for that property. And for the fund, it'll largely be that same process. We get appraisals from licensed appraisers when we get mortgages on properties. Otherwise, we're taking out broker price opinions, which is kind of a lighter version of that evaluation. That'll primarily be on transacting the property. And then on the quarterly basis where we're evaluating it, we're using that third-party reputable data to help triangulate the values.
Fantastic. And forward thinking here, Ryan, do we have a plan to have different kind of like areas for a fund that would be solely focused on like the West Coast, East Coast, different markets? And I'm sure you have feedback on that too, Cameron.
Yeah, I think that's a great question, and one that we're interested in feedback from the investor community around is, are there more niche or focused funds that investors would be interested in? The current fund is really meant to focus on the single-family residential category on Arrive more broadly. You kind of mirror those each individual property. So it's more of a broad view. But absolutely open to the idea of more specialized funds as well, and look to hear from investors if there's specific things that they're interested in there.
Wonderful. And another one in here, and Cameron, I'm going to kick this one to you. How is the REIT fund investment different from the REIT funds in early 2000s that caused the 2008 market crash?
Yeah. So, there's a couple of different segments of REITs. There's private REITs, there's public REITs. So typically when we're talking about the term REIT, we're thinking of the public companies. And there's a couple of, concepts going on here in that question. So maybe if we first tackle the part about what caused the great financial crisis, and largely it was debt driven, right? So there was a lot of irresponsible lending that was going on in the early 2000s, and it created the fuel for this fire of truly a real estate bubble where individuals and companies were kind of incorrectly incentivized to purchase properties. I mean, they were qualifying for things they couldn't. You may have heard the term ninja loans. It's like no income, no job, no assets, right? And people were still getting loans based on that. So when we look back to kind of an ultimate cause for the collapse of the real estate markets 15 years ago, it was largely a credit bubble that was just predicated on poor lending practices. Now, as far as what are the differences between our fund versus a public REIT that may have been more prominent in the early 2000s, in addition to the things that we had talked about when Ryan was answering, how is our fund different than some other funds? And we're kind of hitting on, transparency, pure real estate exposure. One of the things to note about public REITs is that they're public. And when you're investing in public assets, they're subject to a lot of macro forces that are largely kind of divorced from the performance of the underlying asset itself. So you could have Jerome Powell opine on interest rate philosophy, and that'll just send the markets into a complete frenzy when the house on the street really doesn't have a different, value compared to it did 24 hours ago, right? So I would say that our fund is really focused on giving investors exposure to pure real estate on both the rental income side and the appreciation side, whereas public REITs, you're often intermingling assets, public market forces, as well as embedded management companies into those REITs, right? Because you're often purchasing real estate plus a business operating plan where a lot of these funds are internally managed. So you're making investments kind of unknowingly into the management team of a company as opposed to the kind of pure economic exposure of real estate assets in the Arrived SFR fund.
Wonderful. All right, moving back over. Steve has another great question in here. Will the fund be closed to new investors at some point? Could you end up returning some funds if you find that you can't use enough of the cash? Seems like you could have issues without limits, as finding properties have been tough recently. Ryan, I'll kick that one over to you.
Yeah, so at this point in time, the intent is to have the fund kind of always available and monitor the investor interest and amounts that are being invested in the fund on an ongoing basis. And Cameron and the investment team is really focused on planning for that allocation strategy. One of the nice things about the program that we've built is that we have visibility into underwriting more than 60 markets, I think, at this point. And that gives us the opportunity to really underwrite each individual market at each point in time and figure out, okay, what do we view as the best properties that are available at this point in time that we want to make offers on. So that's really the approach that we intend to take for the time being.
Fantastic. All right, moving back over here. There's one about share prices. We chatted about this a little, but I think we have confusion on how they're updated. So one in here from Thomas, how often are share prices updated for the fund?
Yeah, so share prices will be updated on a quarterly basis. And it'll essentially take the net assets of the fund divided by the total available or purchased shares in the fund.
Wonderful. Let's see. Thanks for the feedback too, Brian, that I'm walking through the Q&A right now. To be transparent, there's a lot of similar questions, so I'm trying to get to as many as possible here. One in here about owner financing. Is Arrive doing owner financing for the single family residential properties for tenants?
So currently, we don't participate in a sale leaseback model, if I'm understanding the question correctly, with respect to tenants. We purchase the properties, sometimes with mortgages, currently without, but our fund would wholly own the properties and be the equity owner, such that we collect the rental income from the tenants. But no, we currently don't have a program where it's a sale leaseback model for the tenant. Could be developed as an alternative product, and it's actually one that is very near and dear to Arrive's heart, as kind of some of the original business model ideas revolved around the idea of how do we build up tenant equity. But currently, the fund is going to be the whole equity owner of all properties.
Fantastic. And this is more a strategic question. And obviously, we aren't able to give investment advice as we're not registered advisors. However, what factors will you consider to decide if you want to buy a property in SFR fund or an individual property? Cameron, you walked through this earlier and Ryan did too. So I think of this a little bit more from an investor standpoint. Perhaps what would you look for if you're deciding to invest in a single property or the fund?
Yeah. So I think that the fund is best for people looking for just the easiest possible way to get exposure to a kind of strategically optimized single family residential portfolio. And for individual property offerings, we find that people who have a strong conviction in a particular thesis, say coastal cities, or college towns, right? They may choose to invest in those individual property offerings, and they may do it in a very specific way, in the sense of like maybe somebody wants only properties that are below $250,000, as an example. So, for fund investors, think about it like investing in generally the S&P 500. It's like kind of set it, forget it, get weighted exposure to equities in the US stock market. Similar with the SFR fund, kind of set it, forget it, know that you're getting a diversified bucket of our main thesis points in investments. So I think that they're not mutually exclusive, of course, right? You could say, well, maybe I want some percentage of the fund just for the easy set and forget it. But I do have a very specific thesis that I like South Carolina. And then boom, as South Carolina IPO individual property offerings come online, then that would be your time to invest in those. So, just really different use cases. I would say it's, all about the investor preference and what helps you sleep at night and what kind of exposure do you want. But the SFR fund is going to be the easiest way to get immediate exposure, even if it's just $100, right? With $100, you can invest in one property. And kind of the beauty of Arrived is that with $100 or $500, you can get into 5 properties. But we, kind of up the ante then with the fund. With $100, you might get exposure to 50 properties in 30 markets, and that's a value proposition that a lot of people find attractive.
Fantastic. All right, Cameron, I'm going to throw some rapid fires tax related. The first one's from Benjamin. Can the fund pull from the QTR distributions in the individually owned properties, opt out of distro? And then second one will be on capital gains. So I'll hold.
That's an interesting question of whether you can opt out of a distribution. Ryan, do you have more information on
that? I think the question is basically, can an investor use their dividends or distributions from individual offerings to invest in the fund? Currently, there's no way to kind of automatically take those and invest them into the fund. Right now, dividends are being paid out to your external bank account. What we have planned for the beginning of next year is paying them to an Arrived wallet and shifting that to a monthly basis. And that should make it more convenient for investors who want to immediately go reinvest those dividends either into the fund or into other individual offerings. In long term, it's possible. I shouldn't say it's possible. We're also looking into creating more kind of automated or recurring investment options too, to make that even more convenient. But for now, that would be the approach.
Awesome. Another one in here, one from Glenn. Will capital gains or dividends be reported for liquidations from the fund?
Yeah, as far as, if you were to sell your shares, right, then that would trigger a capital gain treatment. So dividends will be received on a quarterly basis. And then, at the end of the calendar year, you'll receive your 1099 DIV statement. So if I'm understanding the question correctly, that's how the financial flows will end up on your financial statements.
Fantastic. Moving back over to fees here. This one's from Martin. Is the 0.25% management fee in addition to the fees paid in the individual properties that the fund in turn invests? Ryan, I'll kick that to you.
This is equivalent to the asset management fee on individual property offerings. So it's not an additional fee.
So much, Ryan. Great one in here from Chris. We talked a lot about leverage or when we would potentially refinance in the future. So fund related, what is the target rate for Arrive to use leverage?
Yeah. So it's kind of an interplay between what are the returns that we're seeing in the market for individual assets and what is the interest rate on getting a mortgage. The last time that we took out mortgages with the interest rates were around 6.25 to 6.5. So as they approach those levels, we think that there's historical precedent to start adding leverage to properties that we know are, performing at the level that can bear it. And that's also the nice thing about the fund is that you'd have X number of properties. Some of them may not be able to bear the leverage, but some of them do. So on the ones where it makes sense, we can allocate mortgages to that, percentage of the portfolio that can bear it. And overall, you'll get the benefit flow through. Whereas on an individual property offering, it's kind of a higher hurdle because that property in of itself has to be able to sustain it. So 6.25, 6.5, that might be a general range where we start getting the comfort to be able to put mortgages on.
Fantastic. All right, moving back over. There's one on fees. I just want to double down while we're here so everybody's aligned. The 0.25% per quarter, does that translate to 5% total fee if I redeem after 5 years? Ryan, I'll kick that to you.
Yeah, so the 0.25% fee per quarter is the asset management fee for the fund. That fee comes out of the rental income before paying out dividends. And so the dividends investors will be receiving for the life of their investment are already after any of those fees or expenses. And if you add it up over the course of 5 years, then yes, that is what it would add up to. But the kind of thing to note is that it's not a fee that's paid at the end. It's coming out on a quarterly basis of rental income, and the dividends are net of that.
Fantastic. And I see quite a bit of feedback overall about what the future of Arrive will look like in terms of what we're offering. So Ryan, you had mentioned that we will be offering individual properties in the future and the fund. Do you have an idea of what that will look like? I sense a general concern around, if we'll still have individual properties to offer, what the cadence will look like, so on and so forth.
Yeah, no, we're definitely excited to continue to make individual properties available for investors. We'll stick to the weekly or biweekly cadence of releasing those properties, which is really, and we've talked about this, I think, before on previous webinars, but it's dictated based on the process of SEC review for each batch of individual properties where we register them on these with our SEC public offering, then they're reviewed and qualified, and then we can make them available. So investors will still continue to see that happen, and they will see that there'll be individual properties available that mirror those properties that are also being added to the fund. And yeah, we have more properties I know in the works already that investors should start to see move into coming soon in the next few days as well. But yeah, absolutely intend to continue to do that and stick to our current schedule.
All right. Generally speaking, this one's from Katie for a REIT. How does one's individual investment change as more investors enter the fund? Again, because we'll have that always open. Would earlier investors have a lower price per share if they join, say, today versus in 3 months? I'll kick that one over to you, Ryan.
Sure. So essentially, earlier investors in the fund may have a lower share price than investors who join later, assuming that the properties that we're investing in early on in the fund are appreciating or growing in value. And so that's really the way to think about how the fund might change over time.
Wonderful. All right. I think we jumped through most of these. Let's see here. I did see a couple on eviction. I think it's always good to chat through these live while we're here. Cameron, I'm going to kick this one to you. We might not have the exact percentages live right now, but how many properties have arrived, had to file eviction notices? Do you see this increasing, decreasing, or a one-time event? How do you prevent bad tenants from renting again? This is definitely like a 101 question for Tuesday, Friday, but since we've had so many folks ask, I want to be sure we're transparent.
Yeah, no, it's always a great question, and certainly one of the largest concerns you may have as participating as a landlord. So, in terms of a percentage of tenancies that go into eviction, it's tracked at about 4 to 8%, depending on various points in history, but it's been in the single digits. Now, I'd also note that that's the percentage that have gone into eviction, as opposed to the percentage that have been actually evicted. Because one thing to know about evictions is that more than a tool for getting someone out, it's actually more of a tool for collections, right? So when you're filing people to go into eviction, it's kind of like you're saying, hey, I'm really serious about you paying your rent on time. We're going to initiate the eviction process. And then, assuming you don't want to be evicted, then, you really have to stay on top of your rent. So it's been a great tool to help condition, tenants, but we also don't like to go through the eviction process itself. We don't think that it's a win-win for our investors, for Arrived, or for the tenants, right? It can hamper your record and your ability to get quality housing in the future. So we often opt for a program called Cash for Keys, where people, take a lump sum of money in exchange for leaving the property in move-in ready condition, such that it minimizes the vacancy and minimizes the risk of damage to the property. And then the tenants don't get a negative mark on their record and then have a modest sum of money to go and find their next place. So we believe that's more of a, game theory optimized win-win scenario for all parties involved. With that said, there certainly have been not necessarily an increase in the number of evictions. I've actually, seen that the rate is pretty stable. The one thing where I think is more challenging in today's environment, especially post-pandemic, is that evictions are taking longer, right? So it's not necessarily that there's more of them. Each one of them just takes longer. And that's largely from the pandemic era, where court systems are generally backed up from having to process a lot, because the eviction moratorium that lasted at least a year created a huge backlog that really stressed out the local court systems. So, that's what we've been seeing. I would expect that over time, you would have that percentage should go down, because as you're stabilizing your portfolio, you're going to get a higher percentage of long-term tenants that stay in your homes. We saw this at American Homes for Rent. When I had first joined, our occupancy was routinely around 90%. And then incrementally each year, that stabilized up a percentage or so each year, because you do have a higher percentage of those homes occupied with those really long-term tenants. So I think, evictions is always a challenging thing to go through. It's not something that you can ever fully get rid of. But in terms of some of what we're doing, that's why we have defaulting to 2-year leases as, biasing towards tenants who really want to stay, as well as revisiting our underwriting standards this quarter to increase both credit and income requirements to make sure that when we let you through the door, you're someone that's really qualified and will do a lot to make sure that you stay long-term, because we believe that's really the cash flow optimizing strategy there. So a little bit higher barrier entry to get in, but once you're in, we really hope to maintain you. And that's the shift in the strategy the last couple months.
Fantastic. Awesome. All right. We're going to try and rapid fire through 9 or so questions here. Jake is cruising through and answering some of those in chat as well for you all, or excuse me, in the Q&A for you to take a peek at. What happens to the surplus funds that are not invested if there are no properties available? Are they invested elsewhere, money market fund, etc.? Ryan, I will shoot that one to you.
Sure. Yeah, the intent is that we will target new dollars being invested in the fund, have property value commensurate with that. And you'll note that even today we've have over $3 million, I think, of properties added to the fund to be available for investment dollars coming into the fund. Over time, we will likely have cash as well, and we'll seek to earn interest on that cash for the benefit of investors in the fund. So that's the general plan.
Fantastic. All right. And then there was one about estimated overall expense ratio, expense cap. Do we have that in mind?
Yeah. So as far this could be interpreted in a couple of different ways, as far as maybe an expense ratio on the fund shares themselves, which I would say probably the easiest answer is the 0.25% per quarter that Ryan mentioned for the assets under management fee. And then on the property side, if you're asking about what is the expense ratio where you have $1 rent come in, what amount would you expect to turn into cash flow? And that is going to be about 60 to 65 cents on the dollar. So we would expect about 35 to 40 cents in total operating costs. And that includes property management costs, property taxes, insurance, vacancy allowances, and maintenance, right? So that's been a pretty stable number in the industry since the 2010s. So we expect that to continue. And then 1% annual paid out 0.25% quarterly for the administration of the fund.
Fantastic. All right. One in here. Where can I see each of the 8 properties acquisition costs, not just the purchase price?
Yeah. So as far as the acquisition cost versus purchase price, I think one thing to note is whatever price that Arrived goes into contract on is the price that gets passed forward to the fund, or individual property offerings. Mechanically, it's working the exact same way. So if you go on Zillow, check out the property page on there, you'll see that the transacted price will match the acquisition price, right, that the fund is acquiring it for, the individual offerings. Then you'll see itemized lined out the sourcing fee, which we're happy to cover on our 101 webinar as far as the different fees involved. But I think that's the main thing to remember is that we pass through the acquisition costs and the purchase price to the fund, and then we itemize out the fee that Arrive takes.
Wonderful. All right. I think we cruised through a lot of the questions. Again, if we missed any of yours, feel free to ping support@arrive.com. We're more than happy to jump through it. One last one in here, though. I did see quite a few questions about what would the frequency of individual homes being added, whether they're individually or in the fund. Ryan, you chatted through that briefly. Perhaps we walk through our release time that we have for our individual properties, like what that cadence looks like, and then what you envision for the fund before we close out.
Sure. So the release times that we have for individual properties and for the funds will probably be relatively similar. Right now, we make individual property offerings available on Arrive on about a weekly or bi-weekly basis. We're introducing new batches of properties that investors can invest in. And then with the fund, it's likely to be the same. Investors can invest at any time, and we'll continue to add new properties as new investment comes into the fund. We'll report on that within the fund detail page, and in batches report that out to investors of the fund to see which new properties are being added and when.
Fantastic. Awesome. I think we cruised through most of these. Let me just check. There we go. I think we cruised through. Ryan and Cameron, one last one in here from Steven, just because we did walk through this, but I did see one on when can we expect ROI from the fund and when will the fund start to pay a dividend? Ryan, I'll kick that to you.
Yeah, I mean, essentially today at the start of the fund, the fund is already starting to accumulate potential returns. The properties themselves are being leased at the moment, and also the properties have already been, I think we've listed 8 properties that have been purchased into the fund, and those properties will begin hopefully appreciating as well. And so that's already starting. In terms of when we'll start to pay out cash flow and update share prices, the cash flow will start to be paid out as dividends between 1 to 3 months from now. We're just giving a little bit of time for the lease-up period and to accumulate some positive cash flow, and then we'll start paying out the first dividends. And then on a similar timeline, after the first quarter of next year, we'll start updating the share prices. And so investors will see that any unrealized gains in the value of the properties or of the fund will start to show up in the changes to share prices over time. And those will be updated on a quarterly basis as well.
Fantastic. Awesome. Cameron and Ryan, any closing remarks before we shut our virtual doors for the day?
Well, this has been an amazing crew. I think we answered between chat and live over 100 questions. So really appreciate everybody's engaged responses and attention. We're super excited to release the SFR Fund. I'm really grateful for all the support that we've gotten over the last 2.5 years of running Arrive. So just blown away by the support.
Yeah, likewise. Thank you everyone for joining and for going through all of the Q&A with us and for the feedback. We'd love to hear any of your thoughts as well as you start to peruse the fund and potentially invest. And Corinne, thanks a ton for leading the webinar. This was awesome. And for Arrive team for engaging in chat and helping answer questions. Yeah, excited to see everyone here next time.
Fantastic. Well, Ryan and Cameron, as always, thank you for prepared remarks and also going through all the diverse questions that came through for everybody in chat. We're building for and by each and every one of you, and so appreciate seeing such an engaged audience day in and day out. So keep the feedback coming our way. We absolutely love to hear from you. If any questions while the dust settles, feel free to ping support@arrive.com or use that chat function in the bottom right-hand corner of our platform. Otherwise, we will catch you all later and send out the recording. And happy investing, everybody.
Take care.
Bye, everyone.
Thanks, everyone.